Welcome back, ladies and gentlemen. Now, before I get into the content for today, there are just two key announcements that I would like to make. The first one is, as I mentioned on that back table, we do have some flyers regarding some events that are coming up over the next week or so. The first one I just want to highlight to you all and kind of promote is an event that is being done by CPA Australia next week on Thursday. It's between 3 to 6 p.m. in the afternoon. And I really encourage you all, if you can, to attend that event. Now, what's happening there is you can take a copy of your resume. You'll have one-to-one feedback on your resume. You'll also have the opportunity to speak to some professionals from industry, as well as some grad recruiters, and you can get your photo professionally taken for your LinkedIn account. So it's a fantastic session that they've got running next week. If you can attend, please do. In saying that, I have been asked to tell you, ladies and gentlemen, if you're going to register, please make sure you register because you're 100% sure you're going. Please don't take somebody else's position, as there are limited spots. So please make sure that you have a think about it. If you like to go, please make sure you register. The link is available on UTS Online. I've already made this announcement yesterday. The other event is that there is an Accounting Honours information session being held next week on Wednesday. If you are thinking of potentially doing honours, it's a great information session to attend to get some more information on that program. It is a lunch session, so lunch will also be provided. And again, that's next week on Wednesday. An announcement is on UTS Online and as well as the flyers on that back table. So on that note, let's get into today's content. Today is a little bit different compared to the previous weeks that we've gone through, whereby today we actually touch on various aspects from different chapters. So we'll be touching on Chapter 6, Chapter 7 and Chapter 9. Now the reason for this is because we've realised that it's kind of a better sequence to facilitate your understanding of audit. So we're taking kind of little parts of each of these chapters. Now, which parts do you need to read? The page references have been included in the study program section of your subject outline. So I do not need you to read all 3 chapters completely. I need you to follow that program to tell you which page references to actually go and study for the purposes of this topic. And remember, this is the topics that will be covered in the quiz next week. The first section we'll be talking about is audit planning. Okay. So, at the very beginning of the audit, we need to develop an audit plan. Now, what is an audit plan? It basically sets out how the audit is going to be conducted. What are we going to do? How are we going to do it? How much evidence are we going to collect? Things like that. It basically guides the audit and how it will be conducted. Now, the audit plan is covered by ASA 300 over here. Okay, and essentially we need an audit plan in order to ensure that the auditor obtains sufficient appropriate evidence. Now we're going to be talking about the term sufficient appropriate evidence in greater detail next week, but for now I want you to understand that sufficient means enough evidence. We need enough amount, it's an amount measure. We need enough evidence, and appropriate means good quality evidence. And we'll go through this in more detail next week. So we need an audit plan to make sure we get enough good quality evidence to support our opinion. We also need a plan to make sure the audit costs are reasonable. Ladies and gentlemen, we are a profit-seeking organisation. We want to make a profit. How do you make a profit? By managing your costs. So we also create this plan in order to manage our costs and to ensure that we do make some profit as part of this service that we are offering. We also develop an audit plan in order to avoid any misunderstandings with the client. What does that mean? We want to make sure we're on the same page as the client in terms of what the audit is actually auditing, in terms of the responsibilities of each of those parties, and how the audit is going to be essentially conducted. So the purpose of the audit plan is essentially to make sure that we're able to meet these things, these factors. Now, in order to plan the audit, in order to figure out how we're going to conduct the system of audit or the process itself, ladies and gentlemen, this is really important. Before we can plan anything, we need to gain an understanding of the business. We need to gain an understanding of how the business operates. And even further to that, we need to understand the industry and the environment in which the business operates. Why? Ladies and gentlemen, it is based on our understanding of the business and its environment that we are able to identify risks. What do I mean by risks? risks of material misstatement, certain accounts or certain areas in the financial report that have a higher chance of the information being wrong. Why do we want to know that? Because that's where we're going to focus more time, more energy, and more resources into auditing. Okay? So if you want to think about it, the way the process goes is we gain an understanding of the business. Based on this understanding, we identify the risks, so the areas where there is a greater risk of material misstatement. And it's based on those risk areas that we focus more time, more energy, more detailed testing. Why? Because they are the areas that are more prone to material misstatement, and that's what we want to find. So that's kind of the nutshell of what we're going to be talking about over the next few slides. Now, before we go into that in detail, I need to advise you on the different risk terms that you need to be mindful of. Now, there are 4 risk terms that are crucial and key elements in audit. The first one is called acceptable or desired audit risk. Now, going forward, we're going to refer to this just as audit risk, and I'm going to abbreviate it to AR. Now, what is audit risk? Well, audit risk is essentially the risk that we provide an incorrect or inappropriate audit opinion. That's what audit risk is. We provide an incorrect or inappropriate audit opinion. What does that mean? Let me give you an example. We give them an unqualified audit opinion, which is the good one, when we should have given them a qualified one because there were material misstatements. So audit risk is the risk that we provide an incorrect audit opinion. Now that's really bad. Why? Because if we provide an incorrect audit opinion, it exposes us to legal liability, right? We can be sued. As a result, we always want audit risk to be low. We want the risk of us providing an incorrect audit opinion to be as low as possible. Now, notice I said low instead of 0. Audit risk cannot be 0 for the same reasons that we can't provide absolute assurance. We base it on samples, we use judgment, we don't test every single transaction. So what we want to plan the audit in a way that the audit risk is low. The risk of providing an incorrect audit opinion is low. Now, one more thing, guys. The audit risk is set by the audit partner. Okay, they're the ones that decide what the audit risk should be, and in saying that, it's always generally going to be low. It's very rare for it to be anything else. Now, there are a few components under audit risk, and one of those components is inherent risk. Now, going forward, we'll refer to that, we'll abbreviate it to IR. Now, what's inherent risk? Inherent risk is the risk of material misstatement that comes from the nature of the business and the environment in which it operates. This is really important. It's the risk that the information will be wrong that stems from the nature of the business. Now, some businesses have a higher risk of issues, a high risk of material misstatement purely because of how they work. Let me give you an example. Retailers like Woolworths or JB Hi-Fi have a higher risk of theft compared to businesses like Amazon that sells all its products online, right? Because of the very nature of the business and the products that they sell, there's a higher risk of material misstatement. So you're going to start seeing this as we go along. Let me give you one more. A business that engages in international transactions, so they sell their products overseas or they have a lot of different subsidiaries in different countries, those businesses by their nature are more risky, more prone to material misstatement. Why? Different currencies, different exchange rates, and they have to continually convert the currencies and the exchanges. They have to translate the different using exchange rates. So that in itself, as soon as you got complexity like that, that increases the risk of material misstatement. Remember, that's our focus. The material misstatement, risk of the information being wrong or the information being missing, right? So inherent risk, we assess inherent risk. We assess the business based on its nature, the probability of there being material misstatements. Okay, so that's kind of the example of that, and we will be building on this as we go along. The next one is control risk. Now, I've spoken to you about controls in I think it was last week, And as I said, a control, ladies and gentlemen, is any task or any activity that is in place in order to deal with a risk. So do you think the example that I gave you last week was a security guard? So the security guard that you see standing at the exit of a retail store is there to deal with the risk of theft. So that's a control. The other thing I told you about was my security pass. That's a control because it allows me access into my office and it disallows other people who shouldn't have access into that same facility, right? So these are controls, things that the business has in place to deal with risks. So what's control risk? Ladies and gentlemen, listen very carefully. Control risk is the risk that the controls within the business, they're called the internal control environment of the business, will not prevent or detect the material misstatement before it hits the financial report. Okay? So it's not going to stop the issue, or it's not going to detect and correct the issue before it gets to the financial statements, right? Now, another way for you to think about this one is this. If the controls within the business are really good, if they're really good with dealing with the risks that are in the business, if they're really good and they're effective in doing what they're supposed to be doing, control risk is low, right? So control risk is if you think about it, it's a measure of how effective the controls are in the business. So the better the controls, the lower the risk. Write that down. The better the controls, the lower the control risk. The poorer the controls, or better yet, that they don't have any controls, then control risk would be high. So the more effective the controls are, the lower this risk is going to be, because if they're more effective, then they have a better chance at preventing a material misstatement or detecting and correcting it before it gets to the financial report. Okay? That's what we're talking about there. Now, the last one is this element called detection risk. Now, this one's probably the hardest element for students to understand. And essentially what detection risk is, it's the risk that the procedures that the auditor does, the risk that the procedures will not detect the material misstatement. So we'll miss it. We won't be able to pick it up. So it's the risk that our procedures will not pick up the issue. Okay? Now, you might be thinking, why would that ever be the case? And we'll take you through that, okay? But it essentially refers to the risk that our procedures will not pick up the issue. Now, there's only one thing I want to say here. If we want to reduce this risk, we want to reduce the risk that we will not pick up on the issue, guys, what we can do is we can do more detailed testing. So the more detailed testing that we do, right, it leads to a lower detection risk. Because the more detailed testing we do, the lower the risk that we will not detect a material misstatement, okay? The more detailed we are, the greater the risk that we will pick up on issues if there are any. And I'm going to come back to this a bit later as well. So for now, there are those 4 risk elements you really need to know and start understanding how they're linked together, okay? Now, this is basically the sequence of events undertaken in planning and audit. So we're going to go through these throughout the course of the next few weeks. For today's purposes, we focus on the first 4, and you'll have a read of them. I'd rather just get straight into it. Okay, first thing that needs to happen is we need to make client acceptance decisions. Now, the reason why this, has anyone seen this show? It's called, what's it called? If You Are the One. Have you seen it? Raise your hand. Yeah, it's great. If you have some time and you just need a laugh, watch the show. It's great. And essentially it's a really weird dating show. It's really weird. But the thing that was really funny about this one, I was talking to what's really funny about it is sometimes they're just so picky. The men are just so picky. And then other times you have a situation where the quote is, my ideal girl is a female who is interested in men. Right? So setting the bar low. Okay, now why is this relevant to what we're talking about? Ladies and gentlemen, we select our audit clients just as much as they select us. So we actually go through a process where we accept them, right? Now we want to be picky enough that we minimize our exposure to bad clients, Okay, so clients that might be questionable, they might want to conduct fraud and things like that. We want to avoid those types of clients, but at the same time, so we want to be selective. But at the same time, we don't want to be so picky as to not resulting in any clients at all. So there is a process that we go through in identifying clients. Now, these are the steps that we undertake in that initial audit planning. So I'm going to go through each of these in more detail as the next slides come through. So the very first one, ladies and gentlemen, before anything related to the audit even takes place, we have to decide about client acceptance and continuance. Now, what does this mean? Well, we evaluate the potential new client. We evaluate them. We investigate them. Probably one of the first things that we do is we look into their integrity, the integrity of management within that business, integrity. Okay, what do I mean by that? Well, we don't necessarily want to be taking on a client whose CEO or CFO has previously been convicted of fraud or embezzlement or some other scandal, right? So we want to evaluate the integrity of management in order to avoid questionable clients. By the way, the reason why we go through this process, it's actually a way of minimizing our legal liability. We want to minimize the exposure to questionable clients. We want to evaluate them, make sure that they're okay before we take them on. So it's one of the ways that we actually minimize exposure to legal liability. So we look at their integrity. Now, other things that we look into in terms of evaluating our clients or potential new clients is we look at their we look at their standing within the business community. Are they well regarded? Now, that does link back to integrity to an extent. Yes.
Is that a method of detection risk?
Sorry? Okay, no. So it's different to detection risk, and I'll talk more about detection risk a bit later, and if you still have any issues, we'll talk about it then. Okay? So this isn't related to detection risk. Okay? Detection risk is one we're doing the audit. So this is before we've even agreed to it. All right? So we look at that. The other thing, we look at financial stability of the client. Ladies and gentlemen, if there is a client that we are thinking of taking on, and it looks like they're on the brink of bankruptcy, do you think we're going to take them on?
No.
Why not?
Well, because they're not going to pay us anymore. They're going to be banking.
Okay, that's interesting. So the risk could be that they can't pay us. That's probably a really big issue right there. The other one is, ladies and gentlemen, when we take on a client, there's a lot that goes into an audit, and particularly understanding the client. Remember what I was saying before. We first gain an understanding of the client, then we assess the risks, and then we conduct or perform, create the audit plan, and then we do the audit. So if we know that they're not going to stick around for a while, what's the point of just doing a single audit for them? We want a relationship with a client that extends beyond a single year. So we do look at financial stability as well in making our decision of whether to accept them or not. Here's something else we do. It says here, relations with the previous accounting firm. What does that mean? The previous auditor. We want to figure out what was the reason why they no longer have the audit and the client is seeking a new auditor. What happened in that relationship? Now, in saying that, here's an interesting point. We are not allowed to talk to the previous auditors unless the client gives us approval, right? This is under APES 110. We're not allowed to talk to the previous auditors unless the express permission is granted by the client. Now, let me ask you a question. If we ask the potential client, hey, is it okay if we talk to the previous auditors, and they say no, is that a red flag? Yes, definitely. And that in itself would be reason enough for us to turn around and say, you know what, I'm really busy that day. Can't do this audit, okay? Because that's a red flag. That's a massive red flag and an indicator of probably a relationship we don't want to get into with this client. Now, the interesting thing to note here as well is we don't just do this process for new potential clients. We also do it for existing clients. It's called continuing engagements. What do you need to understand, ladies and gentlemen? Every year that we conduct an audit for a company, every year it's a new audit. So every year we sign a new document, the new engagement letter. So every year we have to decide, do we want to be in a relationship with this client for another year? Okay? Now you might be thinking, well, why would you get rid of the client? Usually in practice, based on what I've seen anyway, probably one of the biggest reasons is there's a lot of conflict between the audit team and management. They don't get along. So that could be a reason where the conflict is just above and beyond what the auditors are willing to accept anymore. It could also be a dispute over fees, so they haven't paid us the previous fees. And in saying that, this came up a few weeks ago in your tutorials potentially, but ladies and gentlemen, if the audit client hasn't paid us our fees, that's a relationship because we're a creditor to them and they're a debtor to us, right? That right there means we're not independent. That's a relationship. So that in itself means we can't be the auditor because there's a relationship. We're no longer independent. So that's another potential reason why we can't go ahead with the engagement anymore. So we do this process for both new potential clients as well as the existing ones. Now, another thing that we need to decide on, and I'm just going to speed things up, another thing we need to decide on, or determine, is what's the reason why the client wants this audit? Now, the reason could be as simple as they have to be audited under the Corporations Act, right? Remember, under the Corporations Act, every publicly listed company must be audited at least what? Annually, yes, so at least once. But it could be for some other reason. For example, can you think of any other reason actually? Why would they want to be audited? Oh, I love that. Ladies and gentlemen, he said in order to signal to shareholders. We talked about this in the very first topic. Yeah? They want to send a signal that, hey, we don't need to be audited, but we're being audited because we have nothing to hide. It's a signal of trustworthiness to that we have nothing to hide. We're true and fair. We're being honest. So it could be a signal. What else? Can you think of anything? Potentially. So I'm gonna go with that. That's kind of like if they want to get a loan from the bank. And the bank says, well, in order for me to give you a loan, I want to see a set of audited financial statements. Another reason, ladies and gentlemen, is if they want to engage in an IPO. They want to sell shares, okay, on the ASX. They want to become listed on the ASX. Now, all of these, and again, this comes back to what I was saying, you want to gain an understanding of the business and what's going on in order to identify risks. Ladies and gentlemen, if they are thinking of conducting an IPO and that's why they want the audit, let me ask you a question. If they want to engage in an IPO, they want to sell shares, become listed on the ASX, do they want their business to look really good or just mediocre?
Good.
Very good. So that goes back to what we were talking about last week. If they want the business to look good, the risks are that they're going to overstate revenue or overstate assets or understate expenses or understate liabilities. Do you see what I mean? Based on the understanding of what the business wants to do, we basically become aware or able to identify areas of risk. Now remember, when I say risk, I'm not talking about risk of them not making money. I'm talking about the risk of the information being materially misstated, the information being wrong or the information being missing. Okay, so once we know what the business wants to do, that gives us an indication of where the risk areas are or where the risk accounts are. And that's where we place more time, more energy, more resources into investigating and testing. Okay, and that's why this stage is so important. Now, once we have agreed and we have accepted the nomination to be their auditor, we get engaged. Okay, we prepare and we sign the engagement letter. Now, we have spoken about this before. It is under ASA 210, and essentially this letter is what forms the contract between the auditor and the client. So we spoke about this with legal liability topic. And in this document, we include things such as the objectives of the engagement, the responsibilities of both the auditors and management in the engagement, the fees are also in there, etc., etc. Now, we both sign this document, okay? Just an example of some of the responsibilities. For the auditor, we have a responsibility to act with due care, right? We have a responsibility to be independent, to avoid conflict of interests. We have a responsibility to follow the auditing standards, okay? Management, they are responsible for preparing the financial report. Management is also responsible for giving the auditor access to the information that they need in order to do the audit. So this is all stipulated in that contract and basically make sure that we are both on the same page. If you go back before, it said to avoid misunderstandings. How do we avoid misunderstandings? Putting it on a document and getting both parties to sign it. So they're on the same page, literally, on what is involved in the audit. Now, once that engagement is signed and we are officially engaged, we're in a relationship, we change our status on Facebook and we develop an audit strategy, okay? Now, audit strategy, that goes hand in hand with an audit plan. For now, I just want to mention that there are two main types of audit strategies. One is called a controls-based approach, and the other is called a substantive-based approach. But I will go through that in more detail with you a bit later, all right, and more so next week. So for now, I just want you to know there are two main strategies that we can employ. Now, as part of that planning process, we have to ensure, I should say, that we have the right team. We have the right people on the audit that have the appropriate skills, the appropriate capabilities and competence to do the job. They have the right knowledge of the client's industry to do the job. If you remember, I told you that my specialist knowledge was in insurance. So all of my clients were insurance clients because I had knowledge of that industry, okay? Now, it's also at this stage where they have to ask the question, do we need an expert or a specialist to come in and assist us? One example of that is if we are auditing an oil company, you might want a professional geologist to come in and help you assess what's going on underground, okay? So this is also a question that we need to answer. Now, as I said to you at the very beginning, the absolute first thing, as soon as we get engaged, before we come up with a strategy, before we come up with a plan, the very first thing we need to make sure we do is to gain an understanding of the business, gain an understanding of the industry in which the business operates, okay? Really, really important. Why? Because, ladies and gentlemen, it is only once you understand the business, what it does, and the industry in which it is located, that you are able to identify the risks. The risks of material misstatement, the accounts or the areas where there is a higher likelihood of the information being wrong, okay? Now, ASA 315 is your reference. And what ASA 315 says is that the auditor must gain an adequate understanding in the areas such as the nature of the entity and its operations, the ownership, the governance structure of the entity, the types of investments, how the entity is financed, the applicable accounting policies, the objectives and strategy, and so on and so forth. So it actually sets out areas that we need to gain an understanding of the business. Now, here's the thing. It says you need to understand this stuff about the business. You know what it doesn't say? How much understanding you need, right? How much is sufficient information? That comes down to PJ, professional judgment. So it indicates, it guides us to the areas in which you should get an understanding of the client, but it doesn't actually say how much understanding you need. That comes down to professional judgment. And in saying that, why is this important? I'm just going to say this one more time. If we have an incomplete or an insufficient understanding of the business, we're not going to be able to pick up the issues because we won't know where to look, right? And at the end of the day, we want the audit to be effective and we want it to be efficient. How do we do that? By understanding the business and knowing where the risks are. Once we know where the risks are, we focus our attention on those areas. By the way, guys, that is actually called, it's a risk adverse approach. Oh, sorry, risk averse approach. Sorry. Okay? Now, what does that mean? We spend more time, more energy, more resources allocated to those areas that have a higher risk of material misstatement. Okay? Risk averse, so take out the D. All right? So that's why it's really, really important. Now, why do we need to understand it? As we said, it's so we can identify where the misstatements are likely to occur. Now, these are called inherent risks. If you go back to that definition I gave you, inherent risk is the risk of material misstatement that comes from the nature of the business. You won't be able to pick up on that unless you understand the business. And on that note, the next few slides go into things that you should understand about the business. I'm actually going to explain it to you in a slightly different way. So I'm going to create a new slide, and that's going to cover off on the next few slides, but please make sure you still read them. Here we go. In order to gain an adequate understanding of the business, we actually look into three levels. The first one we look into is the economic level. Okay? We gain an understanding at an economic level. Now, what does that mean? We look at the overall economy and how it is performing. If you think back to a few years ago when the economy wasn't performing very well at all, and we're kind of going into a recession, in situations like that, we need to think, okay, how would this impact on the client? Now, let me give you just one example. If the business let's say it's going into a recession, so consumers have stopped, bless you, consumers have, their demand for the product has gone way down, and the business is having difficulty selling the product, right? Then that gives rise to the potential risk of what we call write-downs of the inventory. They might have to revalue their inventory downwards because they're not able to sell it. Now let me just ask this question, this will make more sense. Who's done ASR? Okay, good. So you would have heard of the concept called you have to record inventory at the lower of cost or net realizable value. Now, what does that mean? It means whichever one of these two is a lower number, that's what you record inventory as. Cost is how much you originally purchased the inventory for, and net realizable value, guys, is how much you're selling it for, or how much you're able to sell it for. Now, let me ask you this. Which one of these is usually lower, the cost or the price that you're selling it for? Yeah, because the difference is your profit, right? But here's the thing. There might be instances where the price goes below cost. Let me give you an example. When you go into the groceries, Coles or Woolworths, if you go at the end of the day or at certain points in the week, you'll see that they've discounted some of their products tremendously. Why? It's approaching expiration. Okay? So in those situations, they'll bring the price below cost just to get the stock out. Another thing could be if they have too much stock and they just want to get rid of it and free up some space in the warehouse, they might reduce the price to a level below cost in order to get rid of it. Now, what's the impact here? When they're doing that, guys, as soon as the price goes below the cost, it triggers what we call an asset write-down. They have to reduce the value of their inventory. Now, if the economy is not performing well, and therefore they're not selling and they have to keep discounting, we want to look at the value of their inventory and make sure it's actually correct based on that rule, the lower of cost and net realizable value. Okay, so knowing how the economy is performing and the impact it has on the client is actually important because it pinpoints where we want to look. Now, here's another one. If the client is a wholesaler and they're selling to a lot of different businesses that are retailers, and the economy goes really bad, the economy goes downhill, and a bunch of those retailers go out of business, then the risk is that if any of those retailers owed the client money, the client won't be able to get that money. Right? So then we need to look at accounts receivable and think about, are they going to actually get this money, or should some of it be taken into bad debt or allowance for bad debt? Right? So again, guys, go back to what I was in the original premise here. You want to gain an understanding of the business and its environment in order to identify where the risks are. Okay? And that's where you focus more. And when I say risk, remember, risk of material misstatement. The next level is the industry level. So we take one step in and we look at the industry level. What's happening in the industry of this client? Now, let me ask you a question. Who here has an Apple mobile phone? So an iPhone. Straight up? Now look around, okay? Who's got a Samsung? Yeah, respect. 2 people. HD, okay. Who's got something else? Okay, you guys don't count, right? You guys don't count. I'm going to point to this story. The mobile phone industry is dominated by 2 main players, Apple and Samsung, right? Now, if you think about the soft drink industry, they're also dominated by 2 players. Who are they? Excellent. Coca-Cola and Pepsi. Now, what's my point? Based on this understanding of the industry in which the client operates, we are able to see that, okay, so because the industry is dominated by these 2 players, if we are auditing a client that's in the mobile phone industry or the soft drink industry and is not Coca-Cola or Pepsi and is not Samsung or Apple, and we look at their profit and their profit has just skyrocketed up, the question we would be asking is, how did they do that? The market is dominated and saturated by these 2 dominant players. So how did their profits skyrocket up? Now, I'm not saying that there's material misstatement. I'm saying there's a risk that we want to look into and investigate further. Again, it comes back to this. Based on the understanding, where are the risks? Where do we want to focus more time and more energy in doing more detailed testing? Because that's where we're more likely to find the issues. Let me give you one more example of industry. Solar panel industry. Now, this one's interesting. A few years ago, I'm not sure if you guys remember this or not, but a few years ago, the government turned around and said, I'm going to give cash incentives and I'm going to give rebates to anyone that installs solar panels on their roofs. Do you remember this? Yeah? And so everyone turned super environmental. Everyone's like, oh, I care about the environment. Green. I'm going to install solar panels on my roof, right? Now, as a result, demand shot up and a bunch of businesses came into this industry. A little while later, the government thought about it. They're like, this is kind of expensive. I think I'm going to just take away this initiative. I'm not going to give the incentives. I'm not going to give the rebates. I'm just going to pull back, right? Sorry. As a result of that, demand fell. Demand plummeted, actually. Do you know what percentage demand went down by? 80%, right? As a result of that demand going down, a lot of the businesses that had come into the industry, they went bankrupt. Now again, how does this link back to this? That happened as a result of one change in government policy. So when we look at the industry, one of the things that we also look at is how dependent is this business on the government? So if the government changes something, what's going to be the impact on the business? Again, gaining an understanding of the business and its environment to see where the risks are, okay? Now, we're almost there. We've looked at 2 levels. We take one more step in, ladies and gentlemen, specific entity level. Specific entity level. Now, this is when you look at the actual business itself, okay? And there are a bunch of businesses that purely because of the nature of how they operate, they're more risky, more risk of material misstatement. Now, I've got a couple of examples. I'm just going to focus on one. Oil company. Okay, let me ask you a question. What's the main asset in an oil company? Excellent. It's oil, okay? Now, where is the oil? Exactly. Can you see it? If it's underground. If you go in or you get it, yeah, but you can't see it as it is, right? Most of it anyway. Now, what's my point here? If you can't physically see the asset, can you accurately value it? Can you accurately value something you can't see?
Well, there's going to be surveys, so...
Yep, but can you accurately, with 100% conviction, say this is the number? Yes or no? No. Ladies and gentlemen, what I'm trying to get at here is when you look at the specific entity and its operations, you want to see how much are they estimating? How much are they using judgment in coming up with the numbers? How complex is the process that they are undertaking? In an oil company case, the best that they can do is they can come up with an estimate of what the oil value is. Purely because of the nature of that, that's a high risk of material misstatement. Why? Because if you're guessing something, if you're estimating, there's a risk that you're wrong, right? If you can't accurately value it, there's a risk that you're wrong. So as soon as you start using, and I'm going to put this in here, but it is repeated later, as soon as you start doing estimates or utilising judgment or doing anything that is a bit complex and outside of normal business activity, that all of these things increases the risk of material misstatement. And by the way, linking it through, that's inherent risk. Yes?
That's an issue where I think all the auditors for all the companies are going to say, oh, this has been misstated.
No. So okay, so you're saying that because of the nature of the industry, we just say it's material misstatement all the time?
Yeah.
Okay. In saying that, that's when controls come through. So just because we've got the risk of material misstatement there, they might have processes, they might have checks in place to reduce that risk when it comes to material misstatements actually getting into the financials. Do you see what I mean? So inherent risk, guys, this is without us looking and caring, or sorry, I shouldn't say caring. This is without us considering the controls in the business, yeah? So this is like step 1. Okay, great question. And you'll see the links as we go along. So this is the 3 different levels. The next few slides kind of go into that in further detail. As you can see, the only thing I just want to mention, and please do read this and read your textbook, but I just wanted to summarise it in that way. But another one, guys, is sources of financing. Now, this links back to what we were saying the purpose of the audit was. If it's to get a loan, then you know what? I'll come back to that one. If they want to sell shares, then the risk is that they want the business to look really good. So we want to look into their revenue, their assets, the expenses, their liabilities to make sure they haven't over or understated. The other one is if they're getting a loan. Now, this one's really important. I'm not sure whether you are aware of this or not. But when a business gets a loan, guys, the bank does not turn around and say, here's your money, have a lovely day. The bank says, here's your money, and you better make sure that you comply with these particular terms and conditions. What are those terms and conditions called? Does anyone know? Excellent. Debt covenants. That's absolutely right. Now that is a massive, massive, massive area where we look into. The reason is this. Now, by the way, a debt covenant could be something like the bank says the business must ensure that their non-current assets is always greater than $1 million, or their debt to equity ratio must be less than 1.5, something like that. So there'll be a bunch of limitations that are placed on the business, and if they breach them, if they breach the debt covenants, ladies and gentlemen, the bank turns around and says, all right, give me back my money. Okay? So it's actually really intense, because here's the thing. If they had the money, they wouldn't have borrowed the money, right? So if the bank then turns and says, okay, pay me back, that can result in a lot of financial strain on the business. So what I'm trying to get at here is the business will do almost anything to try to prevent itself from breaching these. Ding, 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 ding. Risk of material misstatement is right there. Okay? If they want to try to prevent themselves from breaching these, then the risk is they might manipulate the numbers that relate to those debt covenants in order to stop them from breaching it. So whatever the debt covenants are, we'll look into those areas. If the debt covenant was focused on non-current assets, we'll look into the non-current assets. Again, based on the understanding of the business and how it's working, we're identifying risk factors or risky areas, and we focus more attention on them. The other one, sorry guys, just really quickly, as soon as there are related parties, that's a risk. Because related parties is, for example, partner to subsidiary relationships, and they're not at arm's length. So they're straight away risky as well. So when that term comes up, that's a risky situation. Have a read of these. There's also governance that we look at. All right, now business risk. I'm going to speed things up quite a lot. I'm actually really behind now. What I want to mention here really quickly is that there is a difference between this term called business risk and inherent risk, which is what we've been talking about. Ladies and gentlemen, business risk is the risk that the client will fail to achieve its objectives. Now, a really good way of thinking about this is usually businesses want to hit a certain market share, or they want to make a certain profit, or they want to make certain revenue targets. Anything that would stop them or would impact on their ability to achieve those objectives, that's a business risk. Okay? Ladies and gentlemen, examples, competition. If it's a really competitive industry, that's a business risk because it's going to impact on their ability to achieve their objectives. Okay? Ladies and gentlemen, that is not an inherent risk. An inherent risk is focused very much so, inherent risk is focused on material misstatement. Okay? If there's a lot of competition, that doesn't actually link to the information in the financials being wrong. Right? It impacts on the business ability to make the profit or the revenue that they wanted, but it doesn't actually have a financial impact on the statements. That's essentially the key distinction between them. So a business risk is anything that stops them from meeting their objectives, whereby inherent risk is anything that might result in a material misstatement, the information being wrong or the information being missing, essentially, in the financial statements. So our focus is on inherent risk. Our focus is on inherent risk. We consider business risk, but our focus is on inherent risk because remember, our focus is on material misstatements, identifying them as part of our audit. So this slide shows you something interesting. There are many risks that are just called business risks, like competition. Okay? It impacts on the business's ability to meet its objectives. There are other risks that are just inherent risks, where they just impact on the information and the financials. Let me give you some examples. Actually, we mentioned something before. An oil company, they have to estimate the value of the oil. Ladies and gentlemen, that's an inherent risk because it impacts on the information that comes through in the financials. Okay? Anything that requires judgment, that's also going to be inherent risk because that's going to increase the risk of material misstatement. Now, you might notice in the middle here that there is a certain section whereby there's an overlap. Okay? Let me give you an example. The international transactions I mentioned before. Whenever a business is involved, they either have they have outlets in different countries, or they're selling to different customers in different countries, or they've got subsidiaries or parents in different countries. As long as they're doing international transactions, there's always a risk of material misstatement. Why? Because you're using different currencies and different exchange rates. So straight away, the numbers might be wrong. So that's inherent risk. But the Australian dollar and the way that the Australian dollar moves up and down also impacts on your ability to do what? Exporting and importing. That's a business risk. Yeah? It's going to impact on the success of the business. If the dollar moves in a way that is unfavorable for your business, then the demand for your products from overseas will be different. And that's a business risk because that's going to impact on your ability to meet your business objectives. But at the same time, it's also inherent risk because the numbers might be wrong because we need to translate the currencies and so on and so forth. So that's an example where there's an overlap. Okay, so there's instances where it's just the business risk, like competition. You know what? Let me give you one more, another business risk. There might be some manufacturing businesses. Don't know. I don't know what happened with that light. There are some businesses where they're manufacturing businesses that use certain technology, right? And their competitors have now advanced to a point where they're using a more efficient technology. So this business is lagging behind in terms of their manufacturing isn't as efficient. That's a business risk because it impacts on the business's ability to manage its costs and to produce the products, right? That doesn't impact on the likelihood of the financial statements being wrong, okay? So that would be a business risk. Inherent risk, remember, the focus is there a financial statement impact, okay? Now, why am I spending so much time on this? Because you need to make this distinction. You need to be able to see a scenario and identify inherent risks. Risks of material misstatement that come from the nature of the business. This is your introduction. You need to spend the next week focusing on this. There'll be a lot of questions on this in your quiz next week. So really, really important for you to understand it. Now, the next slide, I was going to give you some more examples, but I'm just going to do it here. It was supposed to be in the context of the mining industry, but I might just add it here since we've already started talking. Like I said, competition, that's a business risk. Ladies and gentlemen, the only time that you can argue that competition is an inherent risk is if it's linked to bonuses, right? If they have to meet a certain sales target to get a bonus. That's the only time when the risk becomes, they might manipulate the numbers to get their bonus, okay? That's the only time where competition can be an inherent risk as well if it's tied to the remuneration structure. Okay, so based on that, that's the only way that this can become that. Otherwise, it's just a business risk. Another example is, as I said before, any time where you have to estimate or use judgment in coming up with a particular financial number, that's going to be an inherent risk. Okay, not necessarily a business one. Anything relating to technology is usually over here. I'll just do one more, I'll just do the middle one. As we said, international transactions. So international transactions, because they involve different currencies and different exchange rates, which can impact on our business's ability to sell, which is this, and also the numbers that we are producing in the financials. So this is an indicator of some examples you can think of, but I strongly urge you all to really focus on this because it's going to be a really important skill for you to develop. And this is what I was going to use, but we went through it. Okay. Now, the final thing I want to touch on here before I move on is we also engage in analytical procedures. Now, analytical procedures, you should all be aware of this, refer to things such as when you compare one year to the next, when you do trend analysis, or sometimes you might know it as horizontal analysis. It also includes vertical analysis, it includes ratio analysis. Analytical procedures is when you are analysing financial information to see trends in data and to see relationships between accounts, okay? One of the key things, as I said, is ratio analysis. Now, I will never ask you in this subject to calculate a ratio, but I will ask you to interpret a ratio. So you need to know, you need to go back to your notes and go back to your prerequisite accounting knowledge. You need to know what the ratios are, what they are telling you about the business, because you need to use them to interpret the business. Again, going back, understand the business. Now, why do we do analytical procedures? At this point in time, once you have that understanding of the business based on the economy, the industry, and the specific business level as well, you have a pretty reasonable expectation of what the business should look like in terms of the financial statements. We then do this to see if it actually matches. So we have an understanding or we have an expectation of what the financials should look like, and then we conduct analytical procedures to see whether there is anything that doesn't make sense given your understanding of the business, right? Let me just give you one example. If we know that the business has got a new loan with the bank this year, then we would expect to see liabilities go up, okay? Because that's in line with our understanding. If we know that there has been zero change in the rent situation of the business, rent expense should be consistent, okay? Let me just give you one more. Let's look at ratios for a second. With ratios, inventory turnover ratio. So inventory turnover ratio talks about how quickly the business sells its inventory, its stock, right? Now I'm going to compare two businesses right now. Think about Woolworths and think about Ferrari. Which of those businesses would you expect to have a higher inventory turnover ratio? Excellent. Because they sell, Ferrari? No. Because they sell much more frequently, okay? Now, why am I telling you this? Because, ladies and gentlemen, when it comes to ratio analysis, you need to be able to interpret the number in the context of the business. Does the number make sense given the business? Again, goes back to my understanding of the business. Does this make sense? What doesn't make sense? Those are the areas you want to focus more time, more energy into testing. That's, again, it all comes back to that same premise. So please be mindful, review your ratios. You will need them for next week. All right, moving on to risk. Now, the next few slides kind of go back to some of the elements that we were talking about with audit risk and so on. I'm going to try to explain them in a slightly different way. So bear with me and hopefully this will assist you. Okay, we talked about audit risk. Audit risk is the risk that the audit opinion will be incorrect or inappropriate. Now, what I'm going to do is instead of going through the next few slides, I'm actually going to try to explain it to you in a slightly different way. So bear with me. I'm going to create a new page. Okay, here we go. So first of all, we have audit risk. So we're just going to call that AR. Now, audit risk is the risk that the audit opinion might be wrong or inappropriate. Ladies and gentlemen, we would want audit risk to be what? High, medium, or low?
Low.
Absolutely, yes, well done. Now, on that note, please remember that it is set by the audit partner. Okay, audit risk is set by the audit partner, and it's always low. It's very unlikely that it would be anything else because that would expose us too much. Now, the next thing is we then assess the business. So once we have an understanding of the business, we assess. The first thing we assess is inherent risk. The risk of material misstatement based on the nature of the business. Now let's do this one together. Let's stick to the oil example, the oil company. The oil company, as we talked about, you need to estimate, you need to use judgment, you need to, when it comes to evaluating the inventory. So based on its nature, an oil company has what level of inherent risk? High, medium, or low?
High.
High. Okay? Why? Remember, inherent risk is the risk that the numbers are wrong based on the nature of the business. As soon as you start estimating anything, there's a risk that you're wrong. So with an oil company, it would have quite a high level of inherent risk, again, purely because of the nature of its operations. Now, once we assess inherent risk, we move over to control risk. This is what I was mentioning before. Now, control risk is based on how effective are the controls. Are the controls good in preventing and detecting the issues? Or are the controls not good or are they weak when it comes to preventing or detecting the issues? Now, let's stick to the same example. So it's an oil company, so it's a high inherent risk, and let's just assume that the controls are terrible for this business, absolutely terrible. If the controls are no good and they do not help in preventing or detecting an issue before it hits the financials, what would be the assessment of control risk? High, medium, or low? Very high. Excellent. Now, if you didn't remember this and you didn't write it down before, write it down now. The better the controls, the lower the control risk. Okay? It's only when the controls are not good, they are weak, or there are no controls, that's when control risk is high. All right? Now, this is when you make that final jump. So when you talk about, inherent risk and control risk, guys, and they're saying that they're both high, that means that there is a high risk of MM, material misstatement. Okay, so it's based on the nature, there's a high risk, and the controls are not very good. So there's high risk that they're not being prevented or detected either. So at this point, we've got a high risk client. So what do we need to do? Let me ask you a question. Would we do more detailed testing or less detailed testing in this case? Beautiful, write that down. More detailed testing, absolutely. Okay, because it's high risk. So we would do more detailed testing. Ladies and gentlemen, here's your link. When you do more detailed testing, that is associated with a low detection risk. Why? Because the reason why you're doing more detailed testing is you want the risk of not detecting the issue to be low. So the more detailed testing and the low detection risk are actually linked together, they're associated. Yes, sir. Say that one more time. Correct. Yes. Why would you do more detailed testing? Why would you decide to do more? Because you're dealing with a high-risk client. So based on our assessments of the nature of the business and the controls in the business, we're thinking that there's a high chance of issues. Now, in order to maximize the probability of us finding those issues, we would do more detailed testing. And that's associated with a low detection risk, a low risk of us missing something. Does that make sense? Yeah?
So just on that, would that be, is that more detailed testing throughout the audit?
Yes. So remember, we're talking about planning stage. So this is all we do at the very beginning to determine, are we going to do more detailed, less detailed testing, and then plan the procedures subsequent to that. Does that make more sense? Yep.
Would the risk go down if it's like a repeatable?
Yes. Yes. And we're going to talk about that later. Someone else had their hand up. Awesome. Now think about that, flip it, okay? We now are talking about a cupcake business, because I'm hungry, right? So a cupcake business. Now a cupcake business by its nature is pretty low risk, okay? Everything is pretty evident as to the value of its stock, or the value of its, the processes and the systems and things that it use. It's pretty low risk. Now let's also assume that it's got great controls, fantastic controls that are helping to prevent and detect the issue. So as a result of that, remember what I said, the better the controls, the lower the control risk. So in this particular case, we're dealing with the opposite. It's actually a low-risk client. We think that there is a very low probability of there being issues in this client. Okay? As a result of that, would we do more detailed or less detailed testing? Good. Ladies and gentlemen, write that down. Less detailed. Why? Because it's pretty safe. We think it's a pretty safe client. Now, in saying that, I'm going to add a level to this next week. For now, this is all I want you to start thinking about. Yes, Benji?
Wouldn't you have professional skepticism?
Yes, we'll talk about that as well. But here's the thing you need to... professional skepticism was what you're getting at. What I want to say here is, remember what I mentioned earlier, we are a profit-seeking business. So we want to make sure that when we do testing, we're effective and we're efficient. Efficient, focus on the efficient one. If we think it's low risk, when we think it's low risk, we're not going to waste time doing more work than we think we need to. And that's why it's called less detail. It doesn't mean that we're not going to do testing. It just means we're going to do less detailed testing, okay? And it's more of an efficiency thing. We're not going to do more work than we feel like we need to. And that's why we do assessments in the first place, by the way, is to determine how much work do I think I need to gain comfort over this particular client. Now, one thing I'm going to add here is this. Ladies and gentlemen, when you do less detailed testing, that is associated with a high detection risk. Why? Well, because you're doing less detailed testing, there's a higher risk that you will not pick up the issue. But here's the thing. We're okay with that. Why? Because we think it's a pretty safe environment. That's how you link it back, okay? Now again, I understand that there's a lot to take in today. I totally get that. And we're going to be working on this every single week, but I need you to start seeing the connections. On that note, there's one more thing I want to say, and I will have to move on, and that is this. Ladies and gentlemen, these two elements, inherent risk and control risk, we do not directly influence them. That is why I kept on using the term assess. Why did I do that? Because that is not in our control. We look at the business's nature and we assess how high a risk we think it is. We look at the controls and we assess how good the controls how good we think the controls are. We do not influence these two things. We purely assess them as low, medium or high. Why is this important? Because the only element that we actually set and the only element that we actually control is this one, detection risk. And how do we do it? One sec. How do we do it? By determining how detailed we want to go in terms of our testing. Yes?
Just wondering what if inherent risk is high and control risk is low?
Why do you want to make things complicated? That's a great question. We will talk about that next week. I just didn't want to overcomplicate it. If one is high and one is low, it results in medium. Okay, and I'll talk about that next week. I will talk about that. But I just wanted to keep it simple, and this is as simple as we could get, essentially. So please be mindful that we assess these two. It's not in our control, but we set this. How do we set this? By determining how detailed we want to go. This is, I'm being absolutely honest with you, this is the easiest way I could think of expressing it to you. And we will be building on this as we go along, but I need you to start seeing the links. There's one more thing I'll say, one more. Ladies and gentlemen, inherent risk and control risk, collectively, versus detection risk, they have what we call an inverse relationship, which means what? They're opposites. So look, when these ones are high, this is low. When these are low, this is high. So there is an inverse relationship between them, and that will help you on this path, but I'm going to give you some more information about that next week as well. So as you go through the next few slides, it doesn't really explain it the same way I just did. So I'm hoping the way I did it will help you, but please just read through these information as well. Okay, this is the audit risk model. Again, this is another way that they teach you what I just went through with you. I find that way more conceptually easier for you to understand. But this is the other way. It's called the audit risk model. And again, it basically says that audit risk is a function of inherent risk, control risk, and detection risk. And we set detection risk by using this formula here. Again, you can read your textbook about this, but I think it's easier for you to understand it the other way that we just discussed, okay? Now, this provides you more information. It also makes note of the fact that there is that inverse relationship between inherent risk and control risk versus detection risk. So have a read of this one when you would like. All right, now, as I mentioned, there are two main strategies. So this is the next level that I will take you through next week. I don't want to overcomplicate. I'd rather you focus on what we've already gone through, all right? So essentially, all this one is saying is that when you have set detection risk as low, you're going to end up doing what we call a substantive-based strategy. And if you think detection risk should be high, you'll go with a controls-based approach. Now, again, I will take you through this in more detail next week. Just focus on learning all the risks for now. Okay? Okay, now very quickly, engagement risk. So engagement risk is the risk that the auditor will suffer harm because of a client relationship, even though the audit report was correct. Ladies and gentlemen, the best way for me to describe this one to you is it's reputation risk. It's reputation risk. It's the risk that even though, actually, you know what, I'll write reputation. Even though you've done everything that you were supposed to do, you're going to suffer some form of harm as a result of this client relationship. Now, that could be because they turn around and they make an allegation that you were negligent, even though you weren't. It could it's some other reason, but that's probably the main one, right? And remember what I told you, I think it was in week 1 or week 2, the reputation, the name, and the brand of an audit firm is its greatest asset. Even an allegation can taint it, and it's very hard to build a reputation back up once it's been hit a little bit, right? Now I was thinking about how I can give you a modern example of this, and I thought of a person, Miley Cyrus. So if you know Miley Cyrus, you would know that the way that you think of Miley Cyrus now and her reputation is you wouldn't really be associating her back to when she was Hannah Montana on the Disney Channel, and you're more likely to associate her with twerking, right? Now that's kind of like this. It's a reputation risk. Once you kind of push it and change and taint your reputation in a certain way, it's hard to go back, right? And that's what engagement risk is trying to get at. So we do want to reduce this risk as much as possible because, again, it's our reputation that's on the line. Anything that taints our reputation, it's very hard to come back from. So we want to reduce that as much as possible. By the way, how do we reduce it? By evaluating our clients before we accept them as clients. Avoiding questionable clients, things like that, okay? So I'll let you have a read of this, and by the way, that's what it says here. Selecting the right audit client is critical, yes?
We sorted the bad content.
Sorry?
This like a listing company.
Yes.
A bad client.
Who takes them?
Yeah.
Okay. It gets to the point that if there's a bad, I wouldn't say bad client, if there's a client that no one wants, right, it will get to the point where there will become an understanding reached with there will always be an auditor that will ultimately take the client if they're paying enough. So usually if they don't want to take the client because they think it's too risky, they might turn around and say, I'll take you on, but I'm going to charge you more. Right? So anyone that needs to get audited will ultimately get audited, usually at a premium if they're seen to be high risk. Yeah. Okay, factors that affect inherent risk we've already discussed. So very, very quickly, you need to get an understanding of the nature of the business. You can look at the results of the previous audit. So have we previously found misstatements in this particular client? Now this is what Benji, this is what you were referring to before. Initial versus repeat engagement. Ladies and gentlemen, if we are auditing any company for the first time, there's always a higher risk. Why? We don't know anything about them, right? So it's going to be more detailed work that's required to gain that understanding. And it's once we have that understanding, once we are doing repeat engagements, that we already have knowledge of how the business works, how the system works, and that allows for greater efficiency when it comes to the audit. So an initial engagement will always be more risky than subsequent engagements. As I said, as soon as there are related parties, risk goes up. The same way it does with non-routine transactions or transactions requiring judgment or complexity of any kind. Okay? Fraud. We've talked about fraud quite a lot, so there's only a few things I want to touch on in the last 15 minutes. First of all, as we all know, fraud is covered by ASA 240. And remember, our responsibility when it comes to fraud is we are a watchdog, not a bloodhound. Absolutely. It is not our responsibility to go actively looking for fraud, but rather we must be alert to red flags. Benji, the word that you use, we need to exercise professional skepticism, and there's a slide on that coming up, okay? So ASA 240 essentially goes along with that. It says that the objective of the auditor is to identify and assess the risk of material misstatement due to fraud and to respond appropriately. We don't go actively looking for it, but we do need to make an assessment of do we think fraud is evident within this business or not, and there are certain procedures we do to get there. Remember, we need to apply professional skepticism. Ladies and gentlemen, a questioning mind. That's what we're talking about here, a questioning mind. We cannot just take the questioning mind. We can't just take the management's word for it. We have to gain supporting evidence to corroborate the claims that management is making. We can't just take the word for it. Remember what I told you last week. We don't assume that management is dishonest, but the possibility of dishonesty must be considered. Okay? I thought that was a really great line there. So that's all in there. We talked about this. There are two different types of fraud. The first one is called fraudulent financial reporting. Ladies and gentlemen, that is the manipulation of the numbers. The other one is misappropriation of assets, which is essentially theft of assets. Now, in saying that, there's a link between them. This is interesting because if someone steals, so they steal inventory or they steal cash from the business, and if they then go into the system and try to cover it up, ladies and gentlemen, it's become this, right? They've stolen. So it's misappropriation of assets. But if they go in to try to cover up by changing the numbers, cover up, then it becomes this as well. So there is a link between those two elements. Fraud triangle, we discussed this at length last week. So remember, basically, according to ASA 240, in order for fraud to take place, you would essentially have three elements: some form of pressure or incentive to commit the fraud, an opportunity to commit the fraud, which basically usually comes down to access, right? Access to the cash or access to the system. And finally, some form of attitude or rationalization or a justification in the mind of the person committing the fraud. Okay? So we talked about this last week, and this is all covered in ASA 240. Now, as we have said about everything else, we need to document how we assess fraud. So we need to document everything. Remember, the reason why documentation is so important when it comes to audit is for two reasons. It's documentation that facilitates, let me just say it right here, it facilitates reviews. So when management is reviewing the work of juniors or the partner is reviewing the work of the whole audit team, but it also helps us when it comes to LL. legal liability. If someone makes an allegation that you were negligent, we can say, well, no, we weren't. Here's everything that we did. Here's all the evidence that supports our opinion. Here's all the evidence or justifications behind our judgments and the testing that we have done. So it's incredibly important to document everything. Now, in saying that, who remembers how long we have to hold on to documents for? Yep, 7 years. Fantastic, okay? So documentation, super important. Now, when we assess fraud, this is interesting, and I've got a really good example for you here. When we assess fraud, we look at a bunch of elements, including corporate governance. Now, if you don't remember what corporate governance was, we talked about it, I think, 2-3 weeks ago. Corporate governance is basically the systems, the procedures, the mechanisms in place that deal with the exercise of control. What do I mean? It's anything that business has in place to make sure people are held accountable for their decisions and their actions within the business. Okay? Now, when we look at things like that, let me focus on this one. One of the things that we look at is what's the culture like in the business? Is there a culture of honesty? Is there a culture of ethical behaviour? Let me give you one example. So I used to work at Johnson & Johnson. Now, if you're in MDC, they usually use this example as well. But Johnson & Johnson has a code of ethics, and that code of ethics is called a credo. That's what we called it. Well, that's what it's called, credo. And I'm not even kidding you, if you go into any office, any Johnson & Johnson office anywhere in the world, you'll see this credo as soon as you walk through the door. It's either going to be on the wall or it's going to be, and this is the case in New Jersey, there's a massive stone structure. As soon as you walk in, there's a massive stone structure and the credo is engraved into that stone. Now, what is the credo? The credo is our code of ethics, right? It's 4 paragraphs. You know what it says? The first paragraph says that the first priority that we have is to our doctors, our nurses, and our patients. That's the first thing. The second paragraph goes on to say we then have to make sure we take care of our employees. The third line then says we need to make sure we take care of the communities in which we live. And the fourth one, you know what it says? It says if we do these 3 correctly, profit will come. Okay? Now that is an indicator of culture of honesty and a culture of ethics within a business. If we see that, that's a great indicator of less fraud potentially. Okay? So things like that we look at in assessing the fraud risk within a business. Now, something else that I'll just mention very quickly is the whistleblowing procedures. Are there any procedures or mechanisms in place for whistleblowing? For someone to actually report on somebody else who's committing fraud within the business? Now, in Australia, we have the Whistleblowers Act that does protect whistleblowers, but we also want to see whether the business itself has anything along those lines as well. Again, sorry, coming back to Johnson & Johnson, we had a credo hotline. So if we knew of someone that was acting against the credo, we could actually call this hotline anonymously and report them, okay? Now, again, you might smile or you might laugh, but that's a great indicator of how the business is operating, okay, and the ethical structure of that business. I'm not saying they didn't do anything wrong, but, you know, it's good. All right, now I mentioned this to you before, and I'll mention it one more time. At the appendix to the back of ASA 240, there's a reason why this is so small, because there's a lot of it, right? These are the list of risk factors or red flags that the ASA 240 actually provides as examples to you of what would actually pique our attention. Remember, we don't go actively looking for fraud, but we need to be alert to red flags. Well, what's an example of a red flag? Everything you see here. Okay? These are all red flags. These are what we call indicators of fraud. Now, please note that word, indicator. It's an indicator of possible fraud. It doesn't mean that there is fraud, right? It means that it's an area that we'd like to investigate further. Now, the good thing about this appendices is that it's actually broken down into attitudes and pressures and incentives, opportunities and attitudes and rationalization. So it actually brings it down based on the fraud triangle, okay? So it gives you an indicator of what goes under each section of that triangle. All right, now how do we respond to the risk of fraud? Go back to that diagram I originally drew you, okay? We look at inherent risk, we look at control risk, we look at fraud risks, and the best way that we can respond to those is by determining what procedures should we do to deal with these risks, and in particular, these risk areas. Remember what I said at the very beginning of today. Step 1, once we're engaged, remember, and become official on Facebook, right? Once that happens, we need to gain an understanding of the business. We need to figure out, how does this business work? What's the industry like? What are the factors that impact on how this business, what are the factors that impact on where the risks are in this business? And remember, risk in the context of material misstatement. We don't care, I shouldn't say we don't care, but whether the business is profitable or whether the business is, their market share is going up, that is not our concern. Our concern is the information in the financial statements and the report, is it true and fair? So we want to identify the areas where there's a higher risk of that information not being true and fair, and focus more time, more energy, more resources on those areas, okay? Ladies and gentlemen, really important. Really important. Please make sure that you are focusing on your abilities to identify inherent risks within a scenario. Go and do some practice questions, read your textbook, because this stuff is really, really, really important. There was one more thing I was going to tell you. Oh, yes. Key takeaways, and I'll tell you about your assessment. So key takeaways. So these are the key things that we have spoken about today. The auditor must understand their client according to ASA 315. Why do we do that? To make sure that the audit is effective and efficient. Remember when we talked about the detection risk and whether we would do more detailed or less detailed? Why is that even a thing? Because we want to be efficient. Okay? We want to use that. By the way, sorry, one thing I didn't mention, something else that's in the engagement letter, is when we should be done by. So we actually have a limited amount of time at the client. So we want to make sure that we use that time as effectively and efficiently as possible. How do you do that? By focusing on the risk areas, okay? I need you to be able to identify inherent risks, particularly leading into the quiz next week, okay? Really focus some attention onto that because it's really important. You need to know about analytical procedures and how to understand how to use analytical procedures to fulfill that understanding about that business. The audit risk model, go back to that diagram that I've drawn, go through it. Watch this recording one more time if you need to go back and try to understand how the pieces of the puzzle fit in together. And finally, we must consider the risk of fraud according to ASA 240. So I know there was quite a lot in today's lecture, sorry about that, but it's really important for you to start thinking about these elements. Now, ladies and gentlemen, final thing, I've got 3 minutes, but I'll just take 1 minute, actually 2. Number 1, if you didn't get a chance to grab a flyer on that back table regarding the events next week, please make sure you do so. And the second thing, your video interview assessment. Yeah, got quiet, huh? Okay. The video interview assessment, you will get a notification about that in the next hour. I'm going to go back to the office and do that now. Basically, it's going to be opened up very soon. You will have a week. Okay, so it'll be opened up as soon as you get the email. You'll have the ability to go and actually do your interview. What I suggest is make sure that you are studying and you know that it's covering topics 1 to 3. So everything up to and including the topic last week. So what you covered in tutorials today. Please read the frequently asked questions file as well as the student guidelines document that I've put up. A lot of the questions that I'm receiving have already been answered in those documents. So I will not answer them. I will refer you back to those pages of resources. Please make sure that you are ready before you actually do the interview. It's going to close midnight next week, Thursday. So you have just over a week to do it. I wish you good luck. If you have any questions, let me know. Have a wonderful night. I'll see you next week. Good job, guys.